Hi, everyone. This is Jason Burek of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. One of our listeners asked us for perspective of a bullion dealer who has been in business for a long time and who has been through a number of the bubbles that the Federal Reserve and Wall Street have helped fuel and then pop. And we were lucky enough to get, through our contacts through David Morgan, Andrew Schectman, who is president and one of the co-founders of Miles Franklin, and they've been in business since 1989 for about 25 years. Thank you for joining us on a Wall Street from Main Street podcast, Andrew.
That's my pleasure. Appreciate the opportunity.
Now, Andrew, in terms of what happened after these bubbles, our listeners wanted to know what it was like trying to get supply and fill orders after the technology bubble burst in 1999, 2000, and as the real estate bubble was bursting in 2007, 2008. Because we've all kind of heard stories that like people weren't able, they could lock in a price, I guess, to get a certain amount of metal, but they had to maybe wait 6 weeks or 2 months or things like that. And then there were people who didn't want to wait that long because they thought everything was going to collapse and the world could potentially end. The ATMs would shut down, and there were people going on eBay and they were willing to pay way above spot. What happened? You were boots on the ground. You were actually there. What happened in your experience?
Well, in 99 and 2000, virtually nothing. It was anticlimactic between the tech burst and the Y2K fiasco. Really, people were expecting a lot more than what had happened, and really we saw a tiny, tiny little uptick in December of 99. But in general, we didn't see much of anything at all in gold until somewhere in the neighborhood of 2001 or 2 when it started to finally start to make its move upwards. I would say to you that, in particular, the first reset or the first issue that we had in 2000 was pretty much a non-event. 2008, 2007, 2008, things really began to change, and we can kind of kill a few birds with one stone here and talk about several things. But late 2007 was the first time I had noticed product difficulty. Getting product from one of the 5 major mints of the world became difficult for the first time in my career. And towards the end of President Bush's second term into Obama, there were a lot of people who were concerned about confiscation and the threat of confiscation, and so numismatic sales really picked up during that time. And as the price was creeping, I was actually speaking at a convention with David Morgan together. It was Freedom Fest in Las Vegas. It was summer 2008, and that's when really everything changed. And while we're at the convention speaking, gold fell from 1,000 to 700 in just a few-day period, and silver fell from 21 to 9 during that period. And
I remember that. Yeah, that was. I hadn't bought any bullion yet. I had just started researching the market, reading Ed Steer's newsletter. He's in GATA. I was just learning.
Yeah, and it was kind of an interesting time. Scary to be in bullion, but confusing if you were looking at things from the outside, and it was rather illuminating to me. I'll explain. Regardless of what degree of economics you've studied, how far you've gotten, even just a very rudimentary understanding of economics should tell you that supply and demand move inverse of each other. That's pretty much Econ 101. That's page 1, freshman economics in college or high school. The first page of page 1 is the law of supply and demand, and it basically says that if there's a low demand, there should be a high supply, and if there's a high supply, there should be a low demand. That's just kind of commonsensical. In any case, as the price fell from 1,000 to 700 and on gold, and from 21 to 9 in silver, rather precipitously, it wasn't a slow, drawn-out drop. It was over a period of a few days. A few days after that, every major mint in the world was sold out of product. Every major refiner was sold out of product. Every major dealer on the certified exchange, a network of 1,500 of us dealers, were all asking for product. No one was offering any. The laws of supply and demand had all of a sudden been turned upside down, because one would think, suspend your imagination for a moment and imagine it's not gold. It's a stock. It's any investment. You buy a particular investment, and then it shortly thereafter plummets in price from 1,000 to 700, from 21 to 9, even if it's share price of ABC and XYZ stocks. If the price is falling of the two stocks you bought by 35% and 60%, you would think that though respectively that those two stocks had very little, if any, demand for it. In fact, people were dumping it. Same thing is true here. I would have thought as the price was falling on gold and silver that there would be a plethora of supply dumped onto the marketplace, but it couldn't be further from the truth. Within a few days of the price hitting its corrective low, every major mint was sold out. The U.S. mint was shut down 8 times in 2008. And in fact, they didn't even make any gold buffaloes from 2008 until last year. Platinum Eagles from 2008 till this year, 2014. The Canadian Mint was working 24 hours a day, and were 14 to 16 weeks back ordered on product. The Perth Mint in Australia shut down, took no new business at all in August of that year. The Austrian Mint, again, working 3 8-hour shifts, 24 hours a day, 16 to 18 weeks back ordered. And the Rand Mint in South Africa, the fifth of the 5 major mints, for the first time in 60-plus years, sold out a product and was totally empty, couldn't take any orders. This went on for a period of a couple weeks where I couldn't get anything and was receiving phone calls from the largest distributors across Europe asking me if they could buy anything from us because their supply chains throughout Switzerland and Germany had dried up. It became very confusing as to how the price could fall and all the supply could disappear, and this will lead us into the talk of manipulation, of course, in a moment. But the bottom line is that we saw the price engineered down on paper, and very, very rapidly the prices or the product, the physical product, disappeared. And when it finally did come back online later on, maybe 4, 5, 6 weeks later, for Silver Eagles or Silver Maple Leafs as an example, the U.S. and the Canadian Mint would allow us to place orders, and with that came a nearly 100% premium across the board with 12 to 16-week delivery delays. In other words, $9 silver, you were paying $17 to $18 a piece for Eagles or Maple Leafs from any company in the country and waiting 3 to 4 months to get them. And that was common. That was 2008, and that was the very beginning of what I believed would be the main factor that anyone invested in this market will ultimately have to deal with, and that is difficulty obtaining product before it's all said and done. The one thing that differentiates a gold bull market from every other bull market is that even if the price of the underlying metal isn't doing as well as one would hope, what defines or differentiates a gold bull market from every other is that it appeals to people's concern and fear. And so as the world becomes a scarier place, people's motivation for owning gold to begin with is only intensified. And the same thing is true as the price rises. With traditional investments, if the price of something goes up, you're inclined to take something off the table, to take some profits, and to play with the house's money. But if the price of gold and silver goes up, or heaven forbid the world gets worse than it already is, the reluctance to go back into dollars only intensifies. So I would say to you that 2001 and 2099 was pretty much a non-event. 2008, however, showed the cracks in the foundation, and if I had to sum up what the challenges will be for people going forward, it will be 2 things. One, rising prices, but more so an inability to source readily available product.
Yeah, and I mean, from my other sources, and I've had on, I don't know if you've listened to our interviews, Andy, but, I've had on a lot of people who've went and actually visited the Swiss refiners, like Jim Rickards, like other portfolio managers, like Ronald Stuffele, who also, invests in mining stocks, and he lives right around Switzerland, and he went and spoke with the Swiss refiners. And these guys, do the majority of the world's gold refining, and they can't source as much material. It's becoming difficult for them. They're having to run, 24/7, 365, basically, and they cannot source the material they need for their super large orders, their 9- and 10-figure orders. They're getting central bank gold from the back of the vault, old money that's not, 0.49s gold and things like that. So I just think it's very interesting. We hear the gold bears come out and say, gold has a very large stocks to flow, and that there's so much above ground supply, and that all the supply could flood the market and it'll keep prices in check. But when you actually study the market, real supply and demand for physical, most of this supply that's above ground, it's in very strong hands, and the float is just very tight from speaking with my other contacts besides yourself, that a lot of this gold that is above ground, it's not going to hit the market anytime soon, and it's not going to keep price in check. It's the paper market that's keeping the price in check and keeping a lot of the Western investors or traders, the hot money crowd, the people that follow the nice looking stock chart, that are keeping them away from the gold market.
Well, there's no question about it. I mean, the whole concept of manipulation, there are a lot of people in the industry, those names that I respect, that would disagree with the manipulative process. There are those that would say that the markets are never manipulated. Ultimately, the market derives its own direction. It's too big to manipulate. But I would argue that that's not the case, in particular with gold, and I would also argue that there are no free markets anymore, just manipulations. But in relation to gold, I think it's important to discuss it. I know you wanted to talk about it, so I'll give you my viewpoint of gold manipulation. But it goes back, we can go all the way back to the London gold pool and what have you, but I'm going to go back and build my argument from Clinton's first presidency forward and let you make your decision for yourself. Clinton's first presidency, the first Treasury Secretary, was Robert Rubin. Robert Rubin preached of a strong dollar policy. He was also a crony, of course, of Goldman Sachs. Before that, while at Goldman Sachs, he befriended Lawrence Summers. Lawrence Summers, while the president of Harvard University, wrote a report and then subsequently went to Goldman Sachs, but he wrote a report entitled Gibson's Paradox Revisited. Gibson's paradox is the term in economics that describes the inverse relationship between precious metals, or gold in particular, and real interest rates. So if we go back to the very beginning under Clinton and Greenspan and Rubin and Lawrence Summers being an advisor to Robert Rubin's first presidency or first Treasury job, and then Summers himself became the second Treasury Secretary under Clinton, and Summers has advised every president since, including Obama. But if we go back to that period of time, I would argue it wasn't gold that was being manipulated as much as it was interest rates. In the early 90s, when Clinton was doing this under Greenspan and Rubin and then Summers, the idea was to keep interest rates low, inject money into the bond market to keep interest rates low, to keep the dollar strong, make loans easy, and create an illusion of prosperity through stock portfolios and through our homes and real estate holdings. If our assets are inflating in price, we feel rich, we feel empowered, enriched, and it created this illusion of prosperity. Well, Gibson's paradox, and Lawrence Summers knew this, of course, as an advisor to Rubin and then subsequently becoming the Treasury Secretary himself. He knew that if you create low interest rates, you must hold down the price of gold or it becomes the canary in the mine shaft. So what Rubin and Summers and Greenspan did in conjunction with some of the Western central banks was to lease the gold from the Western central banks at very, very, very low rates, less than 1%. They would take that gold and immediately sell it to the markets, the London Metals Exchange, the COMEX, and the TOCOM in Tokyo, and they would suppress the price. With the proceeds of those short sales, they would buy treasuries in respective currencies, keeping interest rates low, strengthening the underlying currency, and suppressing the price of gold. It made everybody happy. It made the central banks happy as people kept making loans, easy to get money with low interest rates, churning the economy, stimulating the economy, illusionary or not. The commercial banks were happy because they were told from the highest up of high to do this and with sovereign immunity, and they made untold hundreds of millions of dollars, if not more. A few years ago, Blanchard, the company in Louisiana, sued American Barrick and J.P. Morgan on grounds of suppressing the price of gold. And although the case was sealed, went something like this, the results were sealed, the attorneys for American Barrick, the largest producer of gold in the world, said, "We move for dismissal. This is crazy." And upon doing that, the judge in federal court in Louisiana said, "No, there's more to it than meets the eye here. we will go to discovery. Upon going to discovery, or upon it saying we're going to discovery, the Barrick attorneys threw up their arms and said, fine, we've done it. We've held down the price of gold through forward selling, but we've done it at the behest of J.P. Morgan, who has done it at the behest of the Central Bank of the United States. Therefore, we claim sovereign immunity, as they, as an extension of the federal government, have sovereign immunity. Now, the one thing you take away from this discussion, at least until we get to the next part, is that you have the largest bullion bank in the world and the largest producer of gold in the world admitting in federal court that they had suppressed the price of gold. And so when you talk about there being a conspiracy or not, there's plenty of empirical evidence to prove otherwise. Well, somewhere around 2001, you had five commercial banks, holding the world's largest short position in any commodity ever traded, that being in gold, concentrated short position, and all of a sudden we had 9/11 and Afghanistan and Iraq and all the things that turned the price of gold around, that turned the perception of the United States around into a different direction. By 2007 or 8, when the price dropped, here's where things get a little crazy. I believe part of what created that drop in 2008 were the Chinese getting into the game. Prior to this point, there were four very, very large banks that they called the Big Four, or the Big Five sometimes, commercial banks that they would, that guys like Ted Butler would talk about on the COMEX Commitment of Traders report. So always the Big Four or the Big Five. In 07 or 08, all of a sudden it became the Big Seven. That there were these 2 or 3 new big commercial banks that no one knew about who they were, that were now selling on the COMEX exchange and reporting big short positions. I believe it was the Chinese, and here's what I believe that they had been doing ever since. They realized that the Western central banks had suppressed the price of gold for greed, to keep people happy in dollars and in pounds and in francs and in marks and all of the currencies, making loans and making central bankers wealthy. But I believe the Chinese came on board and they realized they had a dilemma. The dilemma that the Chinese had was that they had 2 pockets filled with dollar bills and dollar instruments, and they had to figure out a way to unload these products while obtaining the world's commodities without cutting off their nose to spite their face. So I would argue since 2008, the Chinese have been suppressing the price of every commodity on the planet, not just gold, but all the commodities, selling them short on paper in 2 ways, counterintuitively to what's happening in the world, and also technically. The first way they do it, they reach into their pocket and they short all of the commodities counterintuitively. Now, you get guys that like Jeffrey Christian who admit that the LME, the London Metals Exchange, trades at 100-to-1 leverage. So you get the Chinese selling short paper on all of these commodities at 100-to-1 leverage, counterintuitively to what's happening geopolitically around the world, and economically and politically everywhere. And so they short the price, making people who have purchased these metals for protection wonder why the heck the metals aren't protecting them the way that they should. At the same time, they goose the S&P and the Dow and make people think that the road to retirement is only paved with mutual funds and stock certificates. They also will suppress it below technical averages. They drop it. They have deep enough pockets to suppress it below technicals, knowing that the majority of the financial world uses technical analysis to gauge investment direction. So if you have big enough pockets and you can drop the price below 50 and 200-day moving averages or below technical resistance levels, you get all the hedge funds and the mutual funds out. And earlier last year, you noticed a mass exodus from the COMEX position on all of the, not the commercials, but the traders, the funds. All the funds left and went short. Yeah, the specs, they all went short. The commercials went long for the first time ever. But the bottom line is they drop it below those levels and you get all of the traders out. So now you have everybody out. You have the price artificially low. You have everyone looking elsewhere. With the proceeds of those short sales that they just drove down on everything, not just gold, but copper is a prime example. They dropped it by 50%. And then I just read that the Chinese bought 5 times the copper they need for annual supply. I just read that a few weeks ago. And so the point is, to them, that's money. So they drive down, they get all the competition out looking elsewhere. They get the price artificially low with the dollars that they reached into their right pocket to engineer. The proceeds of those short sales, they buy up all of the world's physicals. And you're noticing it's becoming more and more difficult to get product. It's becoming more and more difficult to get large quantities of product. But they're doing the same thing with every commodity that they can: copper, base metals, oil, land. From La Jolla to Vancouver, it's being gobbled up. Corporations across the globe. Anything that they can buy that's real with their dollars, they do.
Yeah.
There's one piece of the puzzle left. How do they get out of their short positions? Well, they reach into their other pocket, and they pull out their treasuries. You notice the Chinese are no longer buying treasuries. In fact, they're slowly selling them. They sell their treasuries, use the proceeds to cover their short positions in the commodities that they shorted. And when it's all said and done, you have the Chinese who are out of everything dollar, both treasuries and bills, which they've retained value for. Interest rates haven't spiked. Dollars haven't tumbled. And they've purchased all of the world's commodities on the cheap without competition, while everyone is focusing on the returns that are being engineered out of the stock markets. And so, it's a game right now of misdirection, where price is the ultimate tool of misdirection, where people in this country fixate on price, everything all the way down to retail buying. That's why there are no more small hardware stores or small bakeries anymore. They've all been run out of town by Walmarts and Sam's Clubs and Home Depots. So anyways, the bottom line is that price is a tool of misdirection. What started out in the 90s under Gibson's paradox to keep people happy and making loans in dollars and pounds and Deutschmark and all the other currencies, ended up moving to a period where the Chinese said, we'll beat you at your own game, and we'll sell short and accumulate all of the world's commodities on the cheap. So I do believe, without question, that the metals market is being manipulated. It's being manipulated right now specifically so that the physicals can be gobbled up. And before it's all said and done, I believe that perhaps the Chinese will issue a commodity-backed currency, not just gold and silver, but commodity-backed. All of the commodities that they've purchased on the cheap over these years will be pooled together to issue some sort of a competing world reserve currency. And, of course, there's no coincidence that when you see the Chinese and the Russians having high-level meetings with Saudi Arabia, which is the key to it all, certainly Saudi is not happy with the way we're handling Iran and handling Syria. They could very well easily say to the world, we will accept yuan and rubles for oil now, along with euro and dollars. And if that happens overnight, you'll see interest rates pop, you'll see the dollar fall. And so this whole process, last few years, has been, I think, well orchestrated, because if you're a very large entity and you're trying to reposition from dollars to commodities, in either case you can't move too quickly nor be too transparent. If you do, you cut off your nose to spite your face. So one of these days we're going to wake up to find gold repriced or reset to a value much higher than anyone thinks possible, and I think it's not too far down the road.
Yeah, that's a very interesting theory, and you brought up a lot of things to back it up. But I mean, the prices we have at now are not sustainable for any of the miners. I mean, not all of the miners were participating in this scheme to cap prices like Barrick. Barrick was basically a hedge fund. They had sold so much of their gold forward. Now mining company shareholders won't. A lot of mining company shareholders won't go for that. They want the hedge books closed out. They won't hold a mining stock if they're doing that. But in terms of the prices we have now for gold and silver, I really don't know any miners who are making that much money, if at all, on most of their production right now. So I just look at that, and you can't stay. You run a business, Andy. You cannot stay in business for a long time if you're going to be selling a lot of your product at a loss. Maybe you can stay in business for a little bit of time, and either you burn through your cash reserves or you take on credit or things like this. But the miners, they they can't sell shares. Their stock prices are down a lot. It just doesn't make sense from a supply-demand perspective. And then you add in the fact that the Chinese know full well about all the gold manipulation. They've been on conference calls with GATA for a number of years, so they're very familiar with how the game is played. And they've set up, dummy hedge funds, and they have two very big sovereign wealth funds, probably with a whole bunch of underlying buying agents all over the globe in the Caribbean and stuff. Very similar, I guess, to what the Fed does with buying treasuries in the Caribbean, or maybe now what the Fed is probably doing out of Belgium.
Absolutely, and you could draw the analogy, and this is why in 2008. I believe that that's exactly what they did. Is they dropped the price, they jumped into the futures market, dropped the price, and they gobbled up every piece of physical they could find through buying agents all around the globe, because there's no way that you can see the price of something fall by 70% and 30% respectively and find every bit of physical throughout the entire Western Hemisphere gone for weeks on end. I was laying in bed at night with my wife saying, what the hell are we going to do tomorrow? I have no idea. I'm one of 27 companies on the U.S. Mint website that is called an authorized reseller. There's 8 or 9 primary distributors, and then underneath them are 27 of us. We were nominated by Prudential Beige about 5 years ago, which is now Jefferies Beige. These distributors have the right to nominate one company per year if they want. Anyways, the point is that, I'm high up on the food chain, and we couldn't get any product at all, nothing, for weeks and weeks and weeks on end, anywhere. And that was as the price was plummeting. So it's a very interesting theory to think that you can suppress the price on paper and gobble up all the physicals and then cash settle down the road. And that's really what I think is happening, in that right now more than ever, the greatest tool of misdirection in any market is the price. And you have to focus more on fundamentals and good people. Like, for example, in mining shares, to me, it's less about knowing the property and more about knowing the good people. There's a stock that I own, and I'm going to butcher the name. I think it's Peridium. The only reason I bought it is because Bob Quartermain runs it. Bob Quartermain has a great reputation in this industry. I do anyway, you follow good names, you follow good people, you follow good fundamentals, and the rest will happen. If you focus on price and you focus only on price, then you end up getting ripped off, like those that followed Tulving, because Tulving had the best price in the industry, lower than anybody, lower than any of the dealers could sell it for without going out of business. And everyone asked me, why can't you compete with Tulving? Well, Tulving's out of business. They've filed bankruptcy. $50+ million of client money is missing. And if you've received gold 90 days prior to his bankruptcy filing in December, you have to send that gold back to the bankruptcy proceedings, or you're in violation of federal bankruptcy law. So, here again, price is what allows people to get swindled. Price is what allows people to be misdirected, and instead you focus on economics, mathematics, and logic, and good people, good reputation. You won't get in trouble in this industry.
Yeah, that's a good point there. And people who just follow price, that's a lot of technical analysis there. And, you may be able to make fast money, but you're not going to notice. You're going to stare at trees all day. If you're staring at 5 computer screens, you're going to stare at trees and miss the complete forest, that the whole forest is on fire. If you only stare at a couple trees, you may not see the smoke that's starting to build up all around you. So I think it's a very good point. Going forward, though, in terms of supply and demand, are we still seeing good demand out of the Western world for gold and silver for physical metal right now, or are you getting a lot of international orders from clients who are more awake and don't really care as much about the charts and technical analysis as Western investors tend to be?
Well, certainly the Western investors are asleep at the switch right now. Most of the people that I know, I've owned Miles Franklin since 1989, and most of the people here in the Twin Cities, Minneapolis, St. Paul, that I consider to be successful have never held a gold coin before. Most of the people that I know and find influential in this city are oblivious to gold and silver. So the people outside the United States probably have a better understanding, for sure a better historical perspective of precious metals. The first 4 months, 5 months, 6 months of the year have been up and down. Some months have been very strong. Some months have been kind of slow. I think there's a great deal of uncertainty surrounding the market, and the price movement has paralyzed a lot of people into believing that waiting for the next shoe to drop, for the next correction to happen before they enter the market. And I think that's not the right way to do this. I think you have to, first of all, look at gold and silver not as an investment. You look at it as wealth. It's been money for 6,000 years. It'll be money in the year 3,000. I don't look at my gold and silver as an investment, although I'd be lying if I said I wasn't aware of its performance over the last several years. I certainly am. And I'm happy to see it appreciate, but by the same token, to me, it's just the same thing as money in the bank, only safer. And I think that's first and foremost the way to look at it. And in terms of waiting for the next correction, or what do I see as far as the supply and the demand fundamentals, the bottom line is this. There are very few people in this country that are aware of what's going on. There are very few people in this country who've ever held a gold coin before. And you have 5 major mints, U.S., Canada, South Africa, Austria, and Australia. And when they run out of product, that's it. It's game over. Because in the past 3 years, we've done somewhere in the neighborhood of $750 million in sales. And if we've done 1% in buybacks, I'd eat my hat. No one sells anything in a gold bull market, even in the underlying bear correction, because people are scared of what's happening out there. They don't want to go back into fiat currency. They think it's only going to get worse. And a lot of the people who followed this market long enough understand that the prices are being engineered to create some sort of a final outcome, whatever that may be, and they don't really care too much as they do mitigating their position to a falling dollar. Ultimately, the mathematics behind the dollar falling are inevitable. And so you have to position yourself, you have to have strong fingertips, and you have to be able to trust your gut and hang on and know that in the end, the logic of it, the economics of it, and the mathematics of it will prevail. We talk about how big the debt problem is and how big the overhang is. People don't really get it. I mean, just the simple concept of $1 trillion is too big for most people to comprehend. Most people haven't thought about it. But 1 trillion seconds ago was 31,688 years ago. So when we talk about a $17 trillion debt and growing and over 100 trillion in unfunded liabilities through Medicare, Medicaid, Social Security, government and military pensions, the wars we're fighting, all the nonsense in an economy that's lost its manufacturing base, in a country that taxes the wealth creators, in a country that is choking on entitlements, we're in big, big trouble. And ultimately, the big money who sees the big picture sees the trouble that mathematically is falling down upon us. And in order to properly reposition themselves, they have to use price to misdirect and mislead the public so they can properly be repositioned at a cheap price while giving themselves a overly fair price for the dollars in which they are trying to escape from. So I think, you accumulate it as you can. You buy on the dips because one of these days, I believe, I'm going to be put out of business, not for any other reason, but then I can't get any product. And, we've been doing this for 25 years, and that's a big fear of mine. So I say that not to be trite or to sensationalize anything, but because it's truly what I believe is the ultimate end game in this market. If it's that hard to get now, what happens when everyone wants it? Just like everyone was buying tech stocks in 1999. What happens when everyone's buying gold and silver? If it's this hard to get and the mints have been this irregular and dysfunctional in their product output for the last half a dozen years, what happens when it's the thing to do? So that would be my strongest feeling in regards to where this market is going and what will define it from the outside.
Those are very good points, and I think you brought up a great point about physical metal. Objective number one should not be that it's an investment. You should not care that much about the paper price. In fact, you should take a long-term. Investors out there, people out there should see it as insurance for the rest of their portfolio or the business that they own. I see it as a wealth preservation tool and savings because you're not getting any money in your checking account or savings account really, and then the Fed's inflating it away. Your real interest rates are negative because the inflation rate is much higher. So, people can save in silver, they can save in gold, maybe add a little bit of platinum or palladium for diversification purposes. In terms of going forward here, I noticed on the Miles Franklin website you're starting to add different vaults in different countries. Do you expect there to be some type of confiscation risk or a windfall profits tax potentially. Maybe, if they don't get we clearly have inflation here in the United States, but I don't know if it's the amount of inflation they want. Do you expect them to potentially, create a windfall profits tax on gold or silver owners here in the United States then? Because I don't think the politicians are going to go quietly and, let silver go to a couple $100 an ounce or gold go to 5,000 or higher without, trying to do something really foolish.
Well, I got a couple feelings on that. First and foremost, the windfall profit or the confiscation, I would think that the windfall profit would be a more likely scenario because so few people own it. But in a country that prides itself as being the land of the free, the center of free trade and the world reserve currency, whether we're clinging to that or not, whether that's illusionary or not, the point is that still is what we consider ourselves, or at least most of us do anyways. And so I believe that in order for the government to activate eminent domain and confiscate, it's checkmate at very, very best. Instead, how about create a couple of funds like GLD and SLV, the precious metal ETFs? SLV is the single largest stockpile of gold, silver in the world. Whether or not it's all there is debatable, and it is administered by J.P. Morgan, the ultimate fox guarding the henhouse. But suffice it to say, it is reported to be the largest single stockpile of silver in the world. And GLD, the gold ETF, is the fifth or sixth largest stockpile of gold in the world, administered by another fox, HSBC Bank. So here you create, if you look at things from a conspiratorial view, or perhaps just from Occam's razor, the most logical answer is the correct one. In this case, you create two funds that attract all the big investment money, the hedge funds, the mutual funds, the advisors, everybody. Anyone who wants to sell gold and silver who makes their living as a financial advisor would just as soon recommend GLD and SLV keep that money under management rather than sell it through me, where that money probably won't come back, if ever. So you create these funds that attract all the big money, and if you read pages 6 through 12 in those prospectuses titled Risk Factors, you'd be blown away. I've given a speech on the difference between the real thing and GLD as an example. But the most glaring thing that I took from that is that you can never be paid back in the physical gold or silver unless you're one of the big basket holders, which is a huge, obscene amount that you'd have to take out. Well, no one's ever going to get that. They're going to be paid back in dollars. So on a Friday night,
and they've sorry to interrupt you. They've also denied, supposedly, according to King World News and other sources I've had, they've denied hedge fund managers and other high net worth people wanted to take out $12 million or more. These are big, Wall Street money managers who wanted the metal. They were denied too. Yeah,
so they're closing down that window. So here you have all this huge, this stockpile, a huge stockpile of gold or silver that attracts the Wall Street money managers and the hedge funds and the Soroses and the Paulsons, and it's like a magnet. And now you have all this in a central location administered by two government crook banks. And so they come in on a Friday night, you got $1 million in each account, and Monday morning you have $2 million in your money market account. And they look at the world and say, we didn't confiscate anything. We didn't activate eminent domain. We still allow gold ownership in the United States. You can go buy whatever you want. We just closed these two funds and paid everyone we remunerated everyone what their share price was worth as of close on Friday. So that could be done. I think that confiscation is unlikely because in a world that has become so globalized, where information disseminates so rapidly, it would, if our creditors feared Venezuelan-style nationalization of assets, they would dump treasuries before you could say George Washington, and then you'd have interest rates double-digit overnight. And I just think that that is a dangerous move to come door to door to the NRA-toting citizens who are holding gold. It's not as patriotic of a country as it was in 1933. I don't see it happening. I do see currency controls happening. I do see the inability legally to wire funds out of the country. We saw the first shot across the bow by Chase Bank earlier in the year where they, I believe, said any small businesses with under $50,000 in their account can no longer wire money out of the country, something to that extent. But the bottom line is that when we look at currency controls that have happened throughout history, getting money out of the country is the problem. Bringing it back never is. So we have relationships that we've maintained for 25 years in Zurich with Global Gold and BFI Consulting that allow us to do Zurich, Singapore, Hong Kong We are partners in a vault in North Dakota called the Dakota Depository, but our favorite and probably most sought after is Brinks Montreal in Canada. We are the only company in the entire industry that bills people by the number of ounces they hold rather than the percentage of the asset value insured, which is how everybody else does it. Everybody else, including all the other vaults that I'm associated with. Typically, it starts at 0.75% of asset value and then goes down for larger amounts. We bill people based upon the number of ounces that are stored, which makes us very, very unique in the industry. So it's been more because people have really asked for storage programs out of the country, and they've actually way outpaced my expectation as far as what kind of demand there is for it. It's probably our most sought-after product right now, Brinks Montreal Storage.
Yeah, I've heard that from other similar and from consulting clients who own metal or want to start buying more. That's something I definitely suggest to them is, don't go all in on anything, because the number one rule, the most important rule, is that governments can change the rules anytime they want. There's a bunch, these guys are lawyers. They view themselves as above the law. We just saw that stuff with GM. The Department of Justice just subpoena GM and things like that for their subprime, and a lot of these guys, Obama administration included, probably knew, GM was going to have recalls earlier in the year. They knew, and that's why they dumped their stock, or they told their friends. So, I mean, there's the rules can be changed, and I think it's important to not have all of your physical metals in the United States if you can afford to do so.
Fully agree. Couldn't agree more.
Now, in wrapping up this interview, Andy, I just want to thank you again for your time, and I enjoyed this. We should do this every couple months, and please tell our listeners more about Miles Franklin.
I'd be happy to. It'd be my pleasure. We've been in business for 25 years this coming February. We've done $5 billion in sales. We've never had a customer complaint, ever. We've never had a regulatory complaint, ever. We've never lost a package, ever. These are things that should be very, very, very important to your listeners in an industry that's non-regulated. Think about Tulving again. There are a lot of companies out there that have burst onto the scene that have neither the reputation or the longevity that would make me feel comfortable sending them an awful lot of money. Minnesota, the state we're domiciled in, ironically enough, has become the only state in America that is regulating precious metals dealers. Not just if you are in the state of Minnesota. Any precious metals dealer that wants to do business, even by internet, in the state of Minnesota must be regulated, must post an enormous surety bond, and have all of their employees' background checked. So you're finding a lot of the companies around the country are boycotting the state of Minnesota, which just kind of funny underscores how governments interfere and make it worse for the people when they're trying to make it better, instead of giving the citizens of Minnesota the opportunity to buy from everyone across the internet. Most of the companies outside of Minnesota are refusing to post the surety bond and do the background check and give all of the financials that we were required to do as a company based in Minnesota. It was very invasive, to say the least, in terms of providing our own balance sheet and all the stuff that we really didn't want to do. But we are now certified and regulated in the state, which protects your listeners. A big surety bond posted to protect someone from ripping off another party, where anywhere else in the industry this isn't the case. We publish a daily newsletter at milesfranklin.com. You can sign up for it. I believe unequivocally it is the finest source of information in the industry. It's all free of charge. You can read our previous posts, which will, if you go and you'll see there's a link to our blog right from the website. You can see it's every single day, 5 days a week. We're very proud of the newsletter. Most of, in fact, two of our guys that write for us came from GATA, or Le Metropole Cafe. One is Bill Murphy, one is not Bill Murphy. One is Bill Holter, and the other is Andy Hoffman. Both of them, if you've been reading GATA or Le Metropole long enough, you'll know the name Ranting Andy Hoffman or Bill H. Both of them were contributing writers to Le Metropole and GATA for many, many years. So we like to think that we're about information and education and earning business the old-fashioned way, but certainly we would implore or ask people to give us a shot, not only for purchasing precious metals, but sign up for our newsletter. It's free of charge. It encompasses most of what you're reading through 10 or 12 different emails in one. And you can do that at milesfranklin.com and reach us at 800-822-8080 here in Minneapolis from about 7:30 Central Time to 5 o'clock Central Time, 5 days a week.
Okay, great. Well, thanks again for your time, and I appreciate your insights.
It's my pleasure. Hope to talk with you again. Feel free to call anytime.